In this video, I want to share with you how I track my economic indicators. In doing so, I learn what the economy might be up to, and in turn, I can take that information and use it to apply to my asset allocation strategy in order to either protect myself or take advantage of what might be transpiring in the economy in a good way. For those of you who are new to my channel, my name is Jared Ayers. I'm a CFA charter holder. I've been investing for just about 20 years now and have created this channel to share with you the strategies, ideas, and methods that I use to not only outperform the market, but also ensure that I protect any risk of major loss in my portfolio. Enjoy! Before we dive into the details, I just want to share with you two of my fundamental beliefs that drive why, in fact, I even bother tracking economic indicators. The first belief is that markets, that is stock markets, bond markets, etc., and the economy are intrinsically linked. They work together, or the markets basically operate in conjunction with the economy. The second belief I have, which may seem obvious to some of you, is that markets usually lead the economy. So it's not good enough to understand what the economy is doing, but it's actually, if you can, important to come up with a strategy that helps you understand what the economy might be doing so that you can hopefully catch the markets before they react to economic changes at large. So, if I believe that markets and the economy move together, but the markets lead the economy, then what I've had to do effectively is devise a way of looking at economic indicators to help me understand when changes are about to occur. So, for me, what that means is it's not good enough to know where any one economic indicator is at a point in time. It's not good enough for me to know what the change is between 2 points in time. In other words, is something getting better or is something getting worse over whatever 2 periods you want to measure. But it's actually most important to understand the rate of change of any one economic indicator over a period of time. So what that means is, although something may be improving, is it improving at a slower rate, or is it improving at an increasing rate, or if it's getting worse, is it getting worse at an increasing rate, or is it getting worse at a slowing rate? And these concepts are really, really important to me. Now, for some of you calculus nerds out there, you may recognize this concept as the second derivative of basically anything you're wanting to measure. In physics, it's funny. I mean, you can liken it to basically acceleration or deceleration, whereas speed, the first derivative, is sort of distance traveled over 2 points in time. But acceleration, of course, being the rate of change in speed over 2 points in time. But don't worry, we're not going to get into the calculus, math, or any kind of nerdy discussions on that. I want to share with you how I look at these indicators, visually even, and show how anybody really, with a little bit of data and a little bit of patience, can actually track these indicators themselves and see for themselves what the indicators are actually telling them. So let's see that now. So as discussed, one of the things I wanted to show was exactly how I look at economic indicators in terms of their rate of change. So in this first example, we're looking at the consumer confidence or consumer sentiment index versus the S&P 500. So you can see this data goes back to before 2000. And you can see, just looking at this chart now, the green line, just for reference, is the S&P 500 since that time, and you can see, the basically the recession after 2001. You can see the dip in 2008, and here we are. This, I think, goes until towards the end of 2018 with that sharp decline in the S&P 500. Overlying that, you've got the consumer confidence index. The blue line is basically the absolute data points. The orange line or red line is the smoothed data over a 4-month moving average. So I'll cover that, what that means exactly, in another video, but effectively it tries to take out the volatility in the data and look at it on a more smoothed out manner. One of the key things with this chart, as you'll see here, I mean, just eyeballing it, just looking at it without looking at the actual underlying data, you can see that, you know, as it moves, you know, in general terms, it's moving up, right? And as that data starts to turn, as it starts to, you know, come down, you can see that if you look at how the markets react, you know, the data it's not necessarily coming down negative until, you know, it starts to fall off here, but by here it's kind of, you know, we're already into a bit of a downturn. Same with in 08. You know, you can see it's a bit choppy, I suppose, a bit up and down, but here it definitely sort of broke down below some of these other points, and just you know, as it's coming kind of off, you can see that's when the market was starting to turn. So it's not that it's down here that we're trying to catch it. We're trying to catch it as the data actually starts to, I guess, deteriorate. Now, of course, you know, if you look since then, since the 2008-2009 crash, I mean, there's been times when the data does fall off, which is why we use more than one indicator when we're looking at the predictive power of these indicators. So that's, and this is again a lead indicator. Lagging indicators will show a little bit, the data will be shifted a little bit further out, and will not necessarily be able to predict what the economy is going to do, but it helps us confirm that the lead indicators aren't lying to us. And just one note also on indicators, some of them, you know, we are looking at the rate of change in how they're behaving. Other indicators, we are looking at specific thresholds in terms of the actual data. So if I take the next example here, which is the the PMI, which is sort of a proxy for the business sentiment index. And I'll go into this, specifically this indicator, in a later video, but really with this one, you know, your threshold is effectively 50. I mean, we're going to look obviously at what the indicator is doing. Is it deteriorating, or is it deteriorating, or is it you know, improving, but at, you know, this 50% level. I mean, this is a survey-based indicator where above 50 is positive, below 50 is negative, and typically, as you can see if you just drew an imaginary line across here, when it gets below 50, the markets tend to get into trouble. So you can see here, just kind of previous to the 2001 crash, again, I mean, there's maybe some false indicators in here, but as it's sort of climbing out, you can see again in the, here we are up here actually, here we are in the 2008 realm. I mean, it was deteriorating, but once it hit that 50 line is when it starts to basically, when the markets start to react as well. Up here, I mean, we did again have a bit of a dip in 2015, 2016, as some people may recall, but that didn't seem to stop the overall market. It kept marching higher. So again, we have to look at all indicators together, not just one or two, to help us understand what's going on in the economy. But this is sort of what we're trying to do, is we're trying to understand, you know, collectively what is happening in the economy, what is likely about to happen in the economy, and then how can we position ourselves in light of that information to protect ourselves, or of course take advantage of what might be happening ahead. So when we do look at all of the indicators together, this is just a really high level sort of summary of the indicators that I look at. So here's the summary of the 13 as I covered in my last video. This is just at the end of 2018, so not the most recent, but just to give you an indication of how I look at these and what context I put these in. So initially, I mean, what is the indicator? What is the predictive power of the indicator? So is it leading or is it lagging? The predictive power weight, which of course is, if it's a leading indicator, then it's got more predictive power than if it's a lagging indicator. So effectively, I weight the leading indicators at double, effectively, the strength of the lagging indicators. The last data point, so some indicators are weekly, some are monthly, some are quarterly. Obviously, if the data point is more recent, then it's got more power than if it's not so recent. So in this example here, some indicators, again, this is at December 27th, so if it was in the last 30 days, it's going to have more weight. And you can see here the time weight that I'm giving them. So most of them are 100%, most of them are quite current, so in the last month or so. If it's not, so the leading economic index was a laggard there. And then the GDP growth rate, quarter over quarter, I mean, that's a quarterly, so obviously the further out you are in the quarter prior to the next release, the less predictive power that one's going to have. So I mean, that's a great example. It's a lagging indicator, so it doesn't have a lot of predictive power. The last data point was quite some time ago, so the overall weight really is quite low compared to, say, a leading indicator with a recent data point. So that kind of gives me like a total weight of the actual indicator itself. And then, again, what is the direction of the indicator and what is the rate of change? So these are sort of, once I look at each indicator, I just give them a rating. That rating kicks out a score, and effectively I then get a score for each of the indicators, and they could be positive or as low as 0 in this scale. So it's a 0 to 10 scale, and at the end of it I effectively get a risk score that adds up the risks of each one of the indicators, or I guess not really the risks, but the strength, and whether it's positive or negative. Positive could be as high as this scale allows for 13 weighted 13 indicators, and then as low as 0, which would obviously give no score for the indicator. So on a scale of 0 to 10, this collective group of indicators is giving me a risk score of 4.1. So not great, but in my next series of videos I will explain indicator by indicator how I look at each one, what I'm looking for, how I'm actually deciding the direction and rate of change, and also with this overall risk score, how I am using that to decide how to allocate the assets in my portfolio to, once again, either take advantage of the potential upcoming opportunity or to help protect myself from a potential losses due to reduced strength in the economy. So anyway, that's what I really wanted to show in this video. I hope you have seen and heard something that's interesting to you that maybe you hadn't thought about before, and maybe you can take on yourself if you're so interested. Again, I will be providing a little bit more detail in upcoming videos, and I hope you stay tuned for more. Thanks very much. Hi everyone, hopefully you got a little bit of information out of that video that you can find useful and take home. If you did like what you saw, please don't forget to hit the like button, and or the subscribe button if you do want to see more videos in the near future. Please also leave a comment on anything you saw, liked, agreed with, disagreed with. It's all good. I'm open to it all, and I hope to see you back here soon. Thanks very much.